Hey traders, Mixer here. Welcome back to part 2 of the 3-part video series where I teach you how to make money in the Forex markets. Now in part 1 I introduced you to the world of Forex trading and taught you the Forex trading basics. Also I talked about the benefits and risk of trading currencies. Now if you haven't watched part 1 yet, please watch that video first as it will give you a good overall understanding of how the Forex markets work. So in part 2, I'm going to share with you a few simple trading strategies that I use exclusively to make money in the Forex markets. Now one thing I will add is sometimes the simplest trading strategies are the most profitable. So let's get started. As I mentioned in part 1, the Forex markets tend to be less volatile compared to the cryptocurrency or even the US stock market. Now the simple reason is that an entire country's currency does not fluctuate wildly on a daily basis, and on a percentage basis, a move of 1% is considered big versus the crypto market that could fluctuate 5% or more and still be considered normal. As well, given the size of the entire $6 trillion currency market, it's very difficult to manipulate prices, and hence prices tend to be more stable. One thing I researched about the Forex market is that there have been studies done that show that currency prices generally move in a directionless or sideways manner the majority of the time. For example, let's take a look at a chart of the Canadian dollar versus the Swiss franc from 2020 onwards. Now you can see after the initial plunge of this currency pair in March 2020 at the peak of the COVID pandemic, the price of this currency pair barely moved in any trend until February 2021 when it trended up. But once the trend was over, it again traded in a very tight range afterwards. However, I'm not here to say that currency prices are never volatile or prone to wild gyrations in prices like what happened to the British pound versus the US dollar when Brexit was announced in 2016, or when the US versus Japanese yen experienced a flash crash in 2019, but those are generally rare occasions. So one approach that I take in terms of trading the Forex markets is to look for stable market conditions to trade, or stable currency pairs. Now usually research to see if there are no big market moving events such as the US Federal Reserve meetings or the European Central Bank meetings where they discuss economic policies that could move the markets. I want to research that there are no wars going on, no worldwide pandemic, or anything big going on in the financial markets that could cause instability or fear amongst investors. So basically I want to see a boring market where there isn't much going on, everything is like status quo, and this is where I use a trading strategy called grid trading that is perfect for this type of market environment. So let me first off define this grid trading strategy for you. It's a strategy where you don't enter a full-size position right away, but rather divide your trade orders into multiple orders at different price levels based on the market direction. So essentially what you do is if you are buying a currency pair to go up, rather than buy the entire position at once, you buy your initial position at one price, and if it goes lower, then you average down the price by buying more at the same lot size or at a multiplier lot size until your net position is in profit. Let me show you an example. Now here's a chart of the Canadian dollar versus the Swiss franc, and you can see from this chart that the price is quite stable. It's currently trading in a range between 0.70850 and 0.75227. Now you do your research that there's no market moving event going on in the world or no big economic news that will be released in regards to both currencies. So what you do is you split your trade order into 3 orders. You enter an initial position at any price within the current trading range. So for example, let's enter an initial buy position at 0.72355. And if this position goes down, then you would initiate 2 more buy orders. So here you can see that I put the second buy order in at 0.71855 and the third buy order at 0.71355. So basically, I'm going to be buying every 500 pips that the price goes against me. So in this example, you can see that the trade position keeps going lower and your second buy order position at 0.71855 does get filled. As well, you can see that the third buy order at 0.71355 also gets filled. But then the price stops going down and starts going back up. Now your average price of all your positions would be lower than the current market price, and this would result in a net profit for you. Now once you're in profit, you can decide when to take profits. Now it could be a set take profit level, or you can wait until it goes up to the price resistance level. Either way, you made a nice profit on the trade that was basically going sideways. Now let me show you an aggressive and conservative way that you can profit from this grid trading strategy. Now the aggressive way is when you are adding your second order, rather than add an equal amount of lots for each position, you add 2 times the initial lot position. So for example, if your initial position was 1 lot, then the second order is 2 lots. Now if it reaches your third order, you would add 2 times the second order lot size, which is now 4 lots. So basically, you keep doubling the lot size on each order that you add. Now the reason is that you can recover your unrealized losses much quicker and result in a bigger profit. However, it can result in a bigger loss for you if the price doesn't go back up. Lastly, but most importantly, if the currency price goes out of the price range between 0.70850 and 0.75227, then this means that the price is going to most likely trend, so we need to get out of the trade. With the grid trading strategy, you only trade within a predefined price range. Before I share the next Forex trading strategy with you, I want to let you know that this 3-part video series is sponsored by 8Cap Partners. They are a regulated Forex broker with licenses across multiple jurisdictions, so you can feel protected as a client. Also, 8Cap is an award-winning broker with multiple awards for customer service, educational support, and trading experience. In addition to Forex trading, you can trade CFDs on indices, commodities, company shares, and more than 300 cryptocurrencies on their platform. Lastly, one thing that's important to me in choosing a Forex broker is customer reviews. 8Cap has 4.5-star reviews on Trustpilot, as well as 4.6-star reviews on Google. They're currently offering a special promotion for my viewers only, so if you sign up for an account today, you will receive a 20% initial deposit bonus. Please click on the link in the description box below to sign up for an account and start trading today. Okay, back to the video. Now another trading strategy that I want to share with you that I utilize when trading the Forex market also involves looking for stable markets when a currency pair trades within a certain price range. Now this strategy is called range trading. This strategy refers to a scenario where prices fluctuate within a tight price range for an extended period of time without trending one way or the other. Basically, the currency pair trades in a sideways, non-trending market. Now, the difference between the grid trading strategy and this range trading strategy is when prices move within a certain range, you want to buy the currency pair at or near the support price levels and sell at or near price resistance levels. And you keep doing that until the price breaks out of the range where you would exit the trade with a small loss. With the grid trading strategy, you can enter the price at any time as long as it's sitting inside the price range. Now let me show you an example. Here's a chart of the euro versus the US dollar, and you can see from this chart that the currency pair is trading within a price range of 1.12366 to 1.13547. Now, like in grid trading, you do your research and determine that there is no major market moving event that could trigger the price to move wildly. Based on this chart, you determine that the price support level is at 1.12366. So what you want to do here is put a buy order as close to the price support level as possible. Now, once your buy order has been placed, you put a stop loss order below the price support level, and if the price goes below the support level, then you exit with a small loss. However, if it does trigger your buy order and goes up, then you place a sell order to take profit as close to the price resistance level. However, if it doesn't trigger your buy order and the price goes up to the price resistance level at 1.13547, you set a sell order below the price resistance level. Now, if the price goes above the resistance level, then you place a stop loss order there. However, if it does trigger your sell order and then goes down, then you place a buy order to take profit as close to the price support levels. So basically, you keep repeating the same process when the price reaches either the price support level or the price resistance level until the price breaks out of the price range. Now, once it leaves the price range, then you stop utilizing the range trading strategy. Now, let me show you an aggressive and conservative way that you can profit from this range trading strategy. The conservative way is to start off with a small lot size, for example, 0.1 lot, which is basically 10,000 units. So here you would enter in at a price support of 1.12366, and then it goes up, and then you would exit for a profit at the price resistance level of 1.13547. Then you would immediately enter into a sell order at 1.13547, and then it goes down, and then exit at a profit at 1.12366 again. Then you would immediately enter into another buy order at 1.12366, and then it goes up, and then exit with a profit again at 1.13547. Then you would enter into another sell order here again, but this time it didn't go down and went above the price resistance level, so you exit with a small loss. Now let's calculate your total profit on the conservative trade of trading with only 0.1 lot size each time. Now you can see here that you made a total profit of $334. Now the aggressive way is to double or triple the size of your lot size, and you can see here that this will double or triple your profits on each trade and result in some very good returns for you utilizing this strategy. Before I share with you the most important reason why you will have Forex trading success, please take a moment to like this video, hit that subscribe button if you haven't already, and tap the notification bell. You'll be alerted when the next video comes out for this 3-part video course series on how to make money from trading currencies. Okay, I'm going to share with you the key reason why you have a lot of success in Forex trading, and it has to do with mastering how to trade with margin. Now, if you're not familiar with margin trading, it gives you the ability to enter into currency positions larger than your account balance by utilizing the leverage from the Forex broker. So when you trade with leverage, you only need to pay a small deposit known as margin for any Forex trades that you make. Let me show you the power of leverage. Now, as I mentioned in part 1, currencies as an asset class tend to be more stable compared to other assets such as cryptocurrencies, commodities, or even stocks. Also, in stable financial markets, currency prices generally don't fluctuate more than 1% in a day, or sometimes less than 1% in a week. Therefore, if you know how to properly trade a stable currency pair well, then first of all, your risk will be very low, but your potential returns could be very high. Now let me show you an example. Let's say you start off with $10,000, you use no leverage at all, and just exchange your Canadian dollars for US dollars at the bank. Now the US dollar rises 1% relative to the Canadian dollar, and therefore you have a return on your investment of 1%. Now that's not a great return, right? Then you decide to use a Forex broker like ACAP, who can offer you leverage of up to 500 to 1, but you trade conservatively and only use a buying power of 50,000, which is just 5 times the initial capital that you have. So if the US dollar rises 1%, then now your ROI is now 5%. Well, this is not bad, but not great. Then you try using a buying power of 100,000, which is 10 times your initial capital, and if the US dollar rises 1%, then your ROI is now 10%. Then, once you have consistent success, you can increase to 50 times or even 100 times leverage, and you will see your ROI dramatically improve. However, once you go over 100 times leverage, then this is where it can be very dangerous and not suggested. So, the key to mastering the usage of leverage is to start small and slowly increase the leverage that you can use. Once you build consistent profits, you can utilize leverage to make you even more money. But if you have no consistency, then you should not utilize leverage at all. You see, the biggest reason why most Forex traders fail or wipe out their entire trading accounts is because they utilize way too much leverage to try to hit it big. To have financial success in Forex trading, you should trade in a stable market environment, utilize leverage properly, and most importantly, manage risk. Those are the 3 keys to making money in the Forex markets. Thanks for watching part 2 of the 3-part video series of how to make money in the Forex markets. Part 3 will be released shortly. Please make sure you hit the subscribe button and notification bell so you'll be alerted when the next video will be released. I'll see you all in the next video.